Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hi everyone. So welcome to lecture 2, where we're going to look at objectives and dimensions of risk. Now before I actually start with any of the content today, I just want to flag the way that the workshops are sometimes going to work. This is going to be our first week of workshops, and this week in the workshop, what I'm going to do is I'm going to finish any slides that I haven't finished today before going into some practical Excel examples to help you with your online videos. The reason is that there's a couple of lectures during the semester. This is one, week 4 is another, where there is a lot of content and I don't want to rush through it. So what I do in those weeks is I purposely keep the other things I want to cover in the workshop quite light, and that way I have heaps of time to go through the examples, answer questions you may have, and I'm not rushing through anything at the end. Now we saw that this can be a risk for me last week because I said to you guys want to go on and skip the break, and you did skip the break to get an early mark, and then I got really excited about what I was talking about and you didn't get your early mark, and I did go right into the end. So I'm going to take my time. Don't stress if we're not getting right to the end of those lecture slides. That's what we'll finish at the start of the workshop. And I want to start today not with content from this lecture, but content from last week, because I have a confession, and that is when I went through the structure of the industry, because by this time I was aware that I was a little bit time rushed, I didn't tell you guys about a very popular little guy in funds management, and that is the Smurf. What is a Smurf? Other than a little blue man. What do you think it might stand for? Self-managed super, right? SMSF, or self-managed super fund. Both of those are actual tongue twisters, so we don't say SMSF, we often say Smurf. So when I talk about Smurfs in this class, I'm not talking about the cartoon character. I'm talking about self-managed super. When I went through the different types of super funds on the left-hand side, I told you guys about retail, corporate, industry, and public sector, and then I moved on into financial planners and investment banks, so that when I was looking through what I had to cover today, I sat there and I went, I don't remember talking about Smurfs at all, and I'd actually skipped it out. Self-managed super is a type of super fund, but see how it's separated from the 4 types of super funds above it, with little asterisks that ties up to this bit on the retail side? A self-managed super fund is not part of the wholesale side of the industry. It's part of the retail side. Why is that? What is a self-managed super fund? Someone want to shout out a possible definition? All right, so you guys are running self-managed super funds. Are you pulling together other people's money? No. Whose money are you investing? Yourself, that's right. A self-managed super fund is when someone doesn't want to delegate the management of their superannuation to a professional fund manager. They want to manage that money themselves for retirement. It is a big thing in Australia. We're one of the biggest self-managed super funds markets. It's about 30% of assets under management of people actually out there doing it on their own. Now that is partly because some people get a kick out of it. It's partly because some people are sceptical of the fees charged in the overall funds management industry. But at any rate, it's important to be aware that that is one type of super fund that isn't wholesale. It instead sits on the retail side. And we'll talk a little bit about SMERS today when it comes to objectives. So my apologies for missing that out last time. If I ever do skip something, just shout out and let me know, and I'll go back. All right, so today what we're going to do is talk about objectives and the dimensions of risk. This is the perfect starting point for the course, because once a fund is set up and has a governance structure in place, the next thing that they need to do is consider objectives and from that risk. Remember last week I said that if you guys went out, every one of you went to the industry and you got someone to recommend a superannuation fund that was right for you, you could well all have slightly different super portfolios that would suit. Why is one fund not right for everybody? Investors differ. They differ in their goals or objectives. They differ along a number of different dimensions. So if you're going to recommend an investment portfolio, you don't start with your view on assets. Why aren't you working? There we go. You don't start with your view on assets. You don't recommend the same portfolio you recommended your last client. You need to start with the clients themselves. You need to ask, what are their objectives? So what type of thing might we be talking about? What's an example of an investor objective? Think about super. What might investors want from superannuation? Yeah.
Money for their retirement.
Money for their retirement. So they would like to maximise money in retirement. Say. Now, one of the things that people tend to do is they tend to put superannuation as a whole together. But we know that there are two distinct types of defined benefit and defined... Sorry, I just answered it for myself. We know there are two distinct types of super. One is defined benefit, one is defined contribution. Now, if the goal of investing for the end investor is to maximise what they have in retirement, are we talking about a defined benefit or a defined contribution fund? Contribution, that's right. Because if you're a defined benefit fund, you're going to get your promised defined benefit, but that isn't a function of your investment return. That's a function of, it's a array of different things, but it's a function of how long you've been at the company, what your last years of salary were, or perhaps a function of your salary growth, which lessens through time. All of these inputs go into a formula that spits out what your defined benefit will be. But if it's a defined contribution fund, then you're going to care about maximising your consumption in retirement. What if I said another one would be meeting liabilities? What type of investor would need to meet liabilities? There's a number, but there's a couple of ones that are sort of the obvious examples. Insurance. An insurance fund? Right, because they need to meet their claims. The other one is not defined contribution, but defined benefit, because they need to meet their promised benefits, the sponsor of the defined benefit fund. So you know how I said that people tend to lump superannuation together? The big issue with that is that defined benefit, like insurance, is what we call liability-driven investing. Whereas something like a defined contribution is more driven, it's less of a defined term, but I suppose you'd call it asset-driven investing. Asset-driven investing, which is more of the focus of this course, we do a little bit on LDI, but more on asset side, That is a very different kettle of fish when it comes to figuring out a portfolio than if you're focusing on meeting your liabilities. Right, so it's really important to decide what is it that my investor wants. From this, how much risk are they willing to bear? When will they need to start realizing a return? It's only once you understand your investor that you can start to consider what risk is right for them. Because up until now, you've probably spent a lot of time saying, I know what risk is. It's volatility. Well, volatility is one measure of risk, but it's by no means the best measure. And the best measure is going to depend on the individual in question. So the next thing that we're going to do today is to gain an understanding of just how varied investors' perceptions of risk can be. Because remember, think back to modern portfolio theory. Remember, we said the only way that investors will differ is in their individual degree of risk aversion. They're all risk averse. They all hold some combination of the risk-free rate and the market portfolio. They can all borrow and lend at the same rate. They all have the same opportunity set, and therefore their risk aversion will simply define their utility curves, which will decide how much they borrow or lend. That's not going to be the case when it comes to actual portfolio management. We need to understand the objectives to understand the correct dimensions of risk. And we're going to see that people will differ in a lot more ways than just how risk averse they are. It comes down to personality, preference, training, everything. So to give you guys an example of that, I'll give you a couple, but the first example I wanted to give you has nothing to do with creating a portfolio per se. It has everything to do with who you are as people, how you prepare for things, what your learning styles are, what your preferences are. You probably remember that before this year, we were able to offer optional and redeemable mid-semester exams. Now, I'm not quite sure why, it doesn't really matter either way, but nowadays we don't offer them as optional, even though technically they're redeemable, so if you don't turn up, it doesn't really change all that much. But we do have redeemable mid-semester exams. Now, to me, this one is an absolute no-brainer. There is nothing to lose by taking a redeemable mid-semester exam. Because if you do better on the final, we only count the final. If you do better in the mid-semester, we count both. But what if, instead, the other option happened? The other thing was crossed out. In other words, what if you guys had not this, but an optional, but not redeemable mid-semester? In other words, you guys had to make a choice before that mid-semester exam. You could either, one, sit the mid-semester, and it would be worth 25%, and that would mean the final exam would be worth 50%, or two, you could only sit the final exam, and it would be worth 75%. But you couldn't change your mind. Once you sat that mid-semester, it would, by definition, count. There is no right answer to this. But how about everyone take a minute, literally a minute, talk to the person next to you or around you and ask each other, which one would you take? And you don't need to agree, but just tell the person near you, what would you take and why? So do it now. You're going to need to talk, but you don't need to tell me yet. Just discuss it with each other. Show of hands, if you're willing. How many people took option one? Okay. Oh, wow. A bit more overwhelming than I thought. How many people took option 2? All right, this is interesting. So you can see there's a difference in preference, but actually there is a majority going for option 1 to take both. I'm particularly interested in this because I'm one of those lazy students that used to like to do everything and just get it over, get all the pain over and done within one hit. I did a lot of things in summer school for that reason. It was 100% exams, 3 weeks, and it's done. What are some of, I love study, that sounds terrible. But what are some of the reasons why, in a couple of words, why would those that picked option 1, what's the advantage there? Do you see it as being lower risk? What is it? It is lower risk. Now, technically, there is a risk, and that is that you might do worse in the mid-semester. So why might it be lower risk? Sorry? Diversification. Okay, yeah, that's it. So it's a form of diversification. In that, let's face it, I'm writing 2 separate exams, and I might make one of them harder than the other. There's no way of saying it might just be the final exam, so you're actually making a bit of a guess. On average, if one is harder than the other, you're sitting there with an investment in both. I suppose it's also coverage, right? Mid-semester exam is only the first 5 weeks. So in a way, you can have more of a concentrated initial learning that you then carry that learning on into the final. In terms of why you'd only take the final, any particular reasons for that? Yeah. Yeah. That's it. So what if you do bad in the mid-semester? Now the reason I chose this example is I'm going to come back to it several weeks from now, and I'll remind you of this because there is no one right answer, but this essentially actually mimics, in a way, 2 different investment strategies, and they tie back to what we call the fundamental law of active management. You don't need to know about this until a later week, but what we'll learn there is that you could aim to outperform, if you like, based on either making a play on what we call skill or breadth. Now, the skill play is exactly what the argument is for just taking the final exam, right? Take one exam, put all of your energy into that one exam, make it the best exam you've ever taken, and that way you're not going to sort of dilute your performance by a mid-semester where you may have done worse. The breadth focus is to spread your investment over different exams where the performance might differ, and it's more the diversification argument. And again, you don't need, there are brilliant managers that apply a skill focus, there are brilliant managers that apply a breadth focus. But hopefully you're starting to see again, there is no one right answer either way. Now I'm going to do this one more time in terms of getting you guys to pick a side. And that's going to tie in to what we're a bit closer to what we're going to look at directly today. You guys are entering your career for the first time. You've just graduated from university. And you need to make a choice. And you do have a choice. Some people don't, but you do have a choice. You can either be in a defined benefit fund or a defined contribution fund. So again, and let's assume you're going to have to stick with this choice for the rest of your working life. So again, take about 30 seconds, discuss with the same or different people which would you pick and why. Okay? And I'll come back and we'll talk about it. no right answer. But show of hands, who picked defined benefit? Who picked defined contribution? Okay, a little bit more even, but I think the defined contribution people have it. Hopefully, what matters more is the reasons that you guys gave. Is there any key reasons for defined contribution? Sorry? They're confident in their investment performance, so that means they're confident that they want that upside, essentially. Yeah, so you get, so confidence in upside investment performance. And even if you're not the one managing your own money, or at least even if you are partially outsourcing, remember in Australia we do have member investment choice. So if you have faith in financial markets, if you believe in the long-run equity market performance, even if you don't have a SMRF, a self-managed super fund, you might still go into a defined contribution fund, start with a big weight in equities, and then as you edge towards retirement, if you have confidence in your own skill in picking the markets and the timing, you will be edging towards whatever appropriate allocation is at the time. Usually that tends to be de-risking by shifting towards fixed income. What about defined contribution? What's the key advantage or the reason you might pick for defined benefit? No risk. So it's the retiree does not bear the risk of investment performance. Now have a look. They directly, performance. These two directly, they're the flip of each other, right? These are the this is the advantage of the two. Disadvantage is the reverse. In a defined benefit fund, you have no upside in potential in performance. And in a defined contribution, you bear the risk of, so you bear the downside risk of performance. There is no right answer, but what matters is that you guys have thought about the reasons for why you will pick defined contribution and defined benefit. Use that to have a well-considered, justified choice into your final decision. Because now, I'm going to move forward, I'm going to take us into the future, 60 years, 50 years from now. You guys are all, let's say you're all early 70s, and you're just about to retire because the retirement age, let's face it, is going to keep going up. You're just about to retire, and I'm going to put you in scenario 1. The market has completely crashed. Equities are down, really far down. Some of you may have thought to get right away from equities, but let's say that the average investor has not. They've still got a very big equity weight in their portfolio. And by the way, that did happen in the GFC. Defined contribution majority, how good are you feeling right now? Yeah, you kind of probably wish, with the benefit of hindsight, you'd been defined benefit. But remember, you were well considered, you'd made a choice, it was defined contribution. All right, with the benefit of hindsight, it would have been nice to be defined benefit, but at least you thought it through. You have that assurance within yourself that you had made the choice and the market's turned against you. And even better, hopefully you guys are some of the ones that de-risked by that time, so that you didn't have as much in equities and you were more protected. Defined benefit, you guys are probably feeling pretty good right now. But what about this second world? What about we're now, again, you guys are in your 70s, but the market has had 20 decades of unprecedented growth. And even if it crashes 5 years from now, right now you're about to retire and the market is better than it's ever been. Defined contribution, this is real money. You are now retiring on a lot more than you probably thought you would on average. You're in a beautiful position. Suddenly you're going on more cruises, you're buying houses for your kids. You're feeling pretty happy. Defined benefit, nothing's changed for you, right? Because you're in the same position getting your promised defined benefit. So now, defined benefit may be regretting their choice. Defined contribution may be happy. But you at least reasoned it through. What you don't want to do is be in the position that some people are in, and I'm one of them. I had the choice to switch. UniSuper tends to be defined benefit. You can choose defined contribution, but you're supposed to do it within a particular time. I was like, oh yeah, future me will totally decide that, and I never did. So I'm now defined benefit, and I'm still in defined benefit. And I don't necessarily regret it, but in the global financial crisis, UniSuper actually did scale back what they were essentially saying they were going to pay out, which means that I was sort of in a world of defined benefit without the upside and a little bit of downside along with it. Okay, so you can see that the type of risk you face is going to differ depending on your choice. So you need to make an informed choice based on the investor. And the choices I just gave you now, you're in a particularly good position to do that because the investor is you. You know yourself. You know your preferences. Exam, defined contribution versus benefit. When it's delegated portfolio management, you can see how important it is to take the time to understand the person it is that you're investing on behalf of. Because the answer to those questions, remember, you don't know whether your investor, which choice they would have made without spending the time to understand what it is they need and want. So that's what we're going to cover today, the wide variety of investor objectives, and through that, an understanding of the dimensions of risk and how they will differ depending on the investor themselves. So here is a whole list of a number of different ways that investors can differ. The first one is easily the most important, and that is their objectives. I'm skipping over this one only because we're going to cover it in a big table in a couple of slides. But I don't want anyone to think that that isn't important because I'm skipping it. I will come back to it. In fact, it is the number one way in which they can differ because everything will flow from their objectives. But if we move on and come back to objectives, the next way that they can differ is the risks. And that can even be the key risks that they face, not just the risk preferences that modern portfolio theory would have you believe. So, if you guys think back to 1001 or 7006, if you like, if you think back to investments, foundations, what is the biggest risk that you could define for an investor? Firm-specific risk is a massive risk, but you can diversify it. So what about one that you can't? Systematic. The market risk, the systematic risk, that's right. So the number one risk that we are taught from the beginning we can't get rid of is market risk. So for example, in equities, that would be a risk of a big market-wide crash, right? No matter how diversified you are, the market portfolio goes down. If you think back to our example of defined benefit versus defined contribution, we're talking about the number one risk that you guys are taught matters the most. Do both of these people bear that risk equally? No. Who is more protected against market risk? Defined benefit, right? So even in the key risk that you face, if you're in a defined benefit fund, if you have a separate share portfolio, you'll care about market risk. You'll care about market risk in terms of your employment opportunities, but at least your superannuation portfolio is relatively immune. Providing that your superannuation provider doesn't actually go bankrupt, you should get your defined benefit payout. Defined contribution, you've got that added exposure to the biggest risk around, which is market risk. So one of the areas they can differ is in their key risks. Another is in their risk preferences. So we're told that individuals have different levels of risk aversion, and it is true that the average individual is risk averse. But in reality, we also have individuals that are risk loving. If we didn't, gambling wouldn't be as successful as it is. Right? I have a friend that loves to gamble, and he will readily acknowledge that he loses on average. No matter what I've said to him, he will not stop doing it. He say, within reason, but he loves doing it. He knows he loses on average, but he loves the thrill. So that thrill is an added benefit that compensates the loss that he makes financially on average. that is a pretty good representation of the way he lives his life in general. I mean, he has been trying to get me to go bungee jumping our whole lives, and I'm never going to do it, or skydiving. He tends to make decisions pretty much on a whim at times. I'm glad he never knows I'm going to say this about him, but so essentially he is what I would define as someone that is fairly close to risk-loving in a lot of ways in his life. I would design his portfolio very differently to how I design one for myself. I am pretty risk-averse. Not quite as much as my mother, but pretty risk-averse nonetheless. But that said, if I was designing a portfolio for my mother, I'd do it again differently, right? I mean, her portfolio has very little equities and has had very little equities for a really long time because she just goes, yeah, but equities can go down. And I'm like, well, yes, Mum, but you also know that the growth rate on equities is very strong over the long term. It's like, yeah, but they can go down. So you've really got to understand how risk-averse a person is before you can figure out the portfolio that's right. Investment horizon is another one. The first thing to realize is that there is a difference between what we call a holding period and a review period. If we think about superannuation, the time until retirement would be your holding period, right? It's the time that you hold an investment overall. So you might think, all right, if I'm a super manager in a life cycle fund and I'm managing money for a tranche that's going to retire 50 years from now, then my holding period under question is 50 years. So I should invest only considering a 50-year horizon, which means I shouldn't have to worry about what happens in the meantime. But the fact is, it's not just about a holding period. It's also about this thing called the review period. And that's how often the end investor reviews the performance. End investor or your boss, whatever it may be, reviews the performance of the fund in the interim, right? The review period will always be at least, it will never be longer than the holding period. It is often considerably shorter. So if I'm a fund manager and my holding period is 50 years, I usually can't get away with forgetting the medium term. Because particularly in Australia, remember, member investment choice. If I'm investing for the next 50 years, but not worrying about interim performance, and I end up in some investments that have really poor returns over several quarters, maybe several years, then the risk is that the end investor is going to see these several periods of poor performance, right? These consecutive negative review period performance, and they're going to leave my fund and they're going to go somewhere else that is currently performing better, right? So you invest for your holding period, but you keep in mind the review period because you often can't afford to have too many consecutive periods of bad performance, even if you actually are investing for the long term. And that links into what we call dynamics of investing, in that often you're not just investing in a world that is set and forget, so you're not just putting money in an allocation now, doing nothing about it and seeing what happens at the end. Instead, you tend to have a multi-period investment strategy, and that might dynamically change through time. So for example, if you think about the life cycle fund I said, if you want to think about time to retirement as a multi-period game, think of it as a game where the appropriate asset allocation for you now will change as you age. Typically, it will change to something less risky, right? Within equities, you might have less overseas and more domestic equities. As you age, you might have more blue chips than your small speculative shares. Within bonds, you might move more towards an inflation-adjusted bond, away from corporate bonds towards government treasuries, right? All of these things that we're going to learn are ways to scale back your risk. It might be that your job changes and so your portfolio should change with it, right? So it's a case of always monitoring performance through time. And the period itself, even one period, can be very different. And the classic example here is, are you a short-term or a long-term investor? So what I'm going to do is I'm going to split the room. Everyone on my left, you guys are fund managers. Your fund managers that are evaluated every year, right? Your performance is going to be reported in the league tables every year. You're 9 months into the year and you've had an absolutely fantastic year. You've done really, really well, but you're now worried that the market is going to cool off You don't have confidence in your ability to keep performing as well as you are, and you don't want to erode your performance. So what you want to do is find a risk-free investment just for the next 3 months that you can lock that money into and therefore lock in that positive, strong return that will make you a good performer. You guys are long-term investors with a 10-year horizon. And you're multi-asset class investors, and you've figured out what shares you want, right? You've got some in domestic equity, some in international. You've put some in alternative asset classes. You've put some in corporate bonds, but you're trying to figure out, you've decided you want a 10% investment in a risk-free asset. And you're trying to figure out what your risk-free asset should be, right? So you guys want to lock in your money risk-free for 3 months. You guys want to lock in your money risk-free for 10 years. And you've got two choices here. You've got a 3-month treasury bill or a 10-year treasury bond. Fund managers, which one would you pick as your risk-free asset? 3-month treasury bill. Why is a 10-year treasury bond not a risk-free asset for you? Where's the risk involved? What would you need to do 3 months from now? You need to sell the bond, right? So what could happen over the next 3 months that would cause uncertainty in the sale price? Interest rates can change. Exactly. So if you want to lock in your money for 3 months, if you invest in a 3-month treasury bill, then right now you know what your return's going to be, right? Because let's say it's a 0 coupon 3-month treasury bill. The price is the amount that you put in now. No cash flows happen until you get the face value back at maturity. The difference is your return. So you know that that is risk-free for you. 10-year treasury bond, you know the amount that you're investing now, but you don't know the amount you're going to get 3 months from now. Because you're not getting its face value, you're getting its price, because it's still got 9 years and 9 months left on it. So you're going to need to sell it to someone. And if yields have moved in the meantime, then you might sell it for a different amount. And what is the real risk here? That interest rates rise or fall in terms of the price you sell it at? Okay, yes, sorry, you guys said rise, right? I swear I heard rise. Sometimes I hear what I want to hear, but yes, rise. Because what happens when interest rates rise? Prices go down, right? So if the interest rates rise over the next 3 months, you guys are going to have to essentially sell the bond and get your money back at a lower rate. Now, our 10-year investors, which would you pick, 3-month bill or 10-year bond? 10-year bond. If you pick the 3-month bill, 3 months from now, what would you need to do if you were going to keep your strategy as risk-free being in 3-month treasury bills? Buy another one, right? You need to roll it over every single 3 months. So for the first 3 months, you'd know what your risk-free rate is. But 3 months from now, you're going to need to roll it into a new 3-month bill. And if rates have moved in the meantime, so is your return. It's no longer risk-free. Whereas a 10-year bond, that's fine. Put the money in now, you get your coupons, then you get the face value at maturity, no risk involved, providing you don't need to trade out of your position. And we're assuming no government defaults here, obviously. Okay, so you can see that even something as simple as a risk-free rate will differ depending on the investor, their objectives, their constraints, their circumstances. Whereas, if you think about sort of your classic finance theory, people don't spend a lot of time saying, what is the risk-free rate? They just have a risk-free rate, and it just is there, and you just put it in your regression or whatever, you put it on your capital market line, and off you go. So it's very important to tailor the investment to the individual. So investors can differ as well in their circumstances, right? So it might be the need for liquidity or immediacy. So in other words, if I need to suddenly sell my assets, can I do it? And do I have to take a haircut? I think I asked you guys last week, but remind me, what is a haircut? Yeah, that's right. So if I have to sell it as a haircut, it means I'm going to sell it for less than I would had there been a liquid market with a lot of buyers willing. So, for example, I can't remember which one I chose last week. I might have chosen private equity because it is a great example here. Private equity has a secondary market, but it is very illiquid. So what tends to happen with private equity is that you put your money in a private equity fund. It is a closed fund, and the general partner in a private equity fund will spend the next 10 to 12 years. The first few years will be about identifying these private equity investments, and then for each investment, maybe 7+ years down the track, they will exit it after improving the business, positioning it for a public offering, and then you'll start to get your money back. But they don't let you withdraw your money whenever they want, because that would interfere with their strategy. Right? Think about it. If you are going to give money to a startup as a private equity manager and slowly develop that startup, getting it ready for the market, you can't afford to suddenly 2 years in say, oh, sorry, we've got to cut this, end it now, I've got to give my investors back their money. So if you guys put money in a private equity fund, the only way you're getting that money back before the fund is finished its business is if you sell your private equity share to someone else. You can do it, but it's illiquid, so you typically take a discount on net asset value or a haircut. And obviously, the better the fund, the smaller the haircut will be, but it does tend to still exist. Right? Real estate is another one that tends to be fairly illiquid. We're going to go through a number of illiquid assets as time goes by. But remember, people tend to think that all alternatives are illiquid. Not the case. There is one alternative we look at that is very liquid, and that is commodities. Okay, so don't just think alternatives illiquid, and I'll talk about that in our alternatives week. But if your asset is illiquid, that might be fine if you don't need that money for a long time, for the next couple of decades. But if you're someone that will suddenly need the money in a hurry, particularly if you know you might need it unexpectedly, then you're going to have a bit of a problem. I think I told you guys that I had started to look for an investment property, and so I had to make sure that my money was out of my ComSec account because I needed to pay the deposit on a Saturday, right? Well, on Saturday, I actually did buy a house. Yay! I bought it at auction, and luckily I had taken the money out of my ComSec account. But the fact is, some of those shares I had purchased with a long-term view. Not all of them, but some of them. And it turned out that the amount of money I needed, because to be honest, I only decided I wanted to buy an investment property a few months ago. Before I was like, no, I'm going to keep my money in shares for a while, and then maybe 5 years down the track I'll buy an investment property, and then that all changed. So some of the shares I sold at an amount I was happy with. Some of them I bought because I thought they would turn around, and right or wrong, they hadn't yet to an amount I was satisfied with. In fact, some of them were significantly down on what I bought them for. And because I suddenly needed to get my money out of ComSec to be the deposit on my mortgage, I ended up selling them at a, not even a haircut, right? It was just at an amount I wasn't happy selling them for. So if you need money in a hurry, you need to make sure you're not going to take a discount, and you need to consider the fact that even if prices end up where you think they'll be, if a stock really is undervalued, for example, it may take some time before that valuation achieves what you'd like. Whereas if all of my money was in a bank account, I mean, with Rabo, I think I was getting about 3%. It's not great, but it is 3%. It wasn't going to go down. Okay, so think about, do you need it to be liquid, and might you need the money immediately? You've got costs, right? Management fees, transaction costs, taxation. An investment will give the same gross return to every single investor, but it won't necessarily give the same net return. How do you calculate net return? Gross return minus costs. Gross return is identical. If we all bought Telstra shares at the exact same time, at the exact same price, and we all sold those shares at the exact same time, at the exact same price, the gross return would be the same. The net return will be different because of these different costs. Now, if you think about us doing it directly, one of them is taxation costs, right? First of all, Australia is a progressive tax system, right? So if you're earning $50,000, your marginal tax on the next dollar is very different to if you're earning $500,000, which is going to cause a difference in the return you get from Telstra. Transaction costs like brokerage are going to differ depending on the investor. Retail investors tend to pay quite high brokerage fees. Institutions negotiate discounts. Management fees, same again. So maybe your fund manager was the one that was trading shares in Telstra. If you're in a retail A-class share mutual fund, you are going to have higher costs in terms of management fees compared to if you're an institution, where the management fees are a lot lower. And later on in the semester, I'm actually going to get up some statistics for you guys, where you'll see that as the size of the money you're willing to give a manager goes up, often the fees go down to the point that if you're going to give some managers several million, $500 million or something, the fee is actually negotiable. It's not even a fixed amount. They say, you know what, if you're going to give us that much money, we can talk one-on-one and find something we're happy with. Because they want your money. Remember, the management company, their profits are a percentage of assets under management. So the more you can give them, the bigger the discount you're generally going to get. If we go back to taxation, it might be that if you are a particular type of investor, you might be exempt from tax altogether. And that can happen with charities and it can happen with endowments, like the ANU endowment, for example. So you've got to consider, what cost does my particular investor face? You've got to consider the reference portfolios. So we often talk about a legacy portfolio. That's a portfolio that you start out with. So for example, let's say that you are a fund manager and you've just changed funds, right? The fund manager before you was fired for poor performance. You've moved in to take over. And you obviously want to show that you're a lot better than the last guy, because the last guy's now out of a job. But the trouble is, when that first fund manager was fired, they didn't sell off all of the assets in the fund. So you are entering, and you're now managing a fund that you didn't form yourself, the guy before you did, or the girl before you did, right? And you're not just going to sell everything and start anew. Why is that? What would happen if you just sold everything and started again? What would you incur? A lot of transaction costs, right? And heaven forbid, if you're going to sell everything and you happen to buy back something that you already had, you're going to have a really hard time explaining that to the company you work for. Okay, so you walk in and you're stuck with this legacy portfolio. Different people have different legacy portfolios. And how a new asset is going to interact with that legacy portfolio will differ. So let's say that there is a building company out there that is an absolutely fantastic company with very good management, and that you also believe is undervalued. But you happen to walk into a legacy portfolio that was already hugely overweight in building, and it was a multi-asset class portfolio that had a bunch of REITs. So REITs are real estate investment trusts. They're exposed to the property market. They're listed on the exchange, so they're also exposed to the whims of the share market. All right, that company might be a really valuable company, but it would also be highly correlated with your existing portfolio, which for you makes it riskier. If you walk in to a more balanced portfolio that has a range of different industries, a range of different asset classes, whatever it may be, well, then that brilliant company is less correlated. Now, I'm not saying that you don't buy good stocks. You know, if it's a good enough stock, it's worth the correlation. But the fact is, the risk of that stock to you is going to be different depending on the portfolio you start with. People have different background assets, like human capital. Does someone want to, it's a really weird thing to define, but how might you define human capital? Just sort of casually define human capital. Yep, education, background, yeah, your degree, your background. Anything else might come in there? Yeah, your skills, your career. It's essentially the talent and training you have to earn a living over your life, right? So it will depend on the degree you have, your natural ability in the area, the jobs you've had before that may have helped or hindered, depending on the area, you get this particular one. It's your ability to add value for your company and earn an income yourself. Now, someone graduating ANU with a finance degree is going to have a very different set of human capital than someone graduating with an arts degree. Not better or worse, but different. Law degree, same again, right? Because the jobs that you will go into will differ. The ability to add value for companies will differ. The ability to earn a living will differ. But when you are just leaving uni, you have a very large stock of human capital, and then you essentially wear down your human capital stock as you age. And when you're about to retire, your ability to earn a living in the future is as depleted as it may get for most people. Some people never will retire, and those people it's going down, but they still have a stock of human capital as they're about to retire. But it certainly does decline through time. Residential property is another one, and these effects will interact. When you guys are just leaving university, you may have a small residential property portfolio or none at all. You may still rent, but you've got a very large stock of human capital. And then as you age, your human capital stock will go down, but probably your residential property portfolio will go up as you have your own home, maybe an investment property or two, and so on. It's really hard, though, to put human capital and your residential property portfolio into an asset allocation decision, because human capital, it doesn't have a metric in that way. And residential property, you might know what you paid, but you're not going to get it valued every quarter just so you can update how it interacts with the property in your super fund. It just doesn't work that way. Okay, so these are actually really important things that will affect what your portfolio should be, but they're hard to measure. Other things that are hard to measure are business or personal considerations, right? Even if it's true that you're not it might be that in reality you would be better off outsourcing the management of your super than doing it yourself. But if you love it, if you really love investing for yourself, then that creates a benefit that isn't measured by the numbers. Your career, I think I gave this example last week. If you're an equity fund manager, then your background asset, wow, even the slides are telling me to hurry up. I love it. If you're an equity fund manager, then you have a very big exposure to the equity market in your job. So you may want to diversify away from equities in your portfolio. If you're in the building industry, in an area that's in high demand and is therefore relatively immune from equity market fluctuations, then you may be able to afford to take some more equity in your super. But you might not want to take such a high weight in REITs and unlisted property, whereas the equity fund manager doesn't have the exposure to property, so can take on a higher unlisted and listed property weight. So there are all the other ways in which investors can differ. And remember, because this depends on the investors, the examples I've given you are just that. They're examples. So in an exam, if I say to you, for example, pick 3 ways that investors can differ and provide an example of each, you might pick these and your examples that you give might be completely different through the room. It's fine as long as they're well explained and legitimate, right? Don't just say, how can they differ? They can differ in investor circumstances, e.g. immediacy, right? That's an okay answer. You'll get some marks, but not that many. But if you say, for example, some investors may need cash more immediately than others, and here is one of the ways that may be, right? And you give an example like I gave, you give your own, it's fine. But the fact is there are so many different examples. You can pick what makes sense to you. It just needs to tie back to the topic. So I know that it does seem like there are so many ways they can differ, but that actually gives you flexibility in answering the question. You just need to show depth in your response. All right, so let's go through this objectives table and then we'll take a break, because after that we're going to move on to the measurement of risk. This is a big table and we will spend time going through why the ticks are the way they are. But the reason that I'm giving it to you like this is that I actually think this will come in handy when it comes to your revision. Because some people actually I've seen have put this on their little one-sided page of notes. If you understand what it is we're discussing, then the nice thing about a table like this is you can put it up there. And if you get a question of, pick 3 investors and ways in which their objectives may change, you can use the table to give you reminders. But you understand what sits beneath the table and you can explain it properly in an exam. So what you can see here is we have a number of different types of investors, and we discussed all of these in week 1, with the exception of Smurfs, because I forgot, but we've talked about that now. And we've got a number of different possible objectives. There are more, but here are some of the major ones. And you can see that depending on the investor, the objectives can be very different. And straight away, remember at the start of today, I said that people lump superannuation together, and yet there's almost no alignment between defined benefit and defined contribution in their objective boxes. So let's have a look quickly at the objectives. We've got maximising expected utility of wealth or consumption. We've got meeting liabilities, minimising contributions, impact on profits, consumption in retirement. Remember, that's one of the things we started with today. If you're a DC fund, your big tick is maximising your consumption in retirement. Supporting spending programs. You might have absolute or relative return targets. I'll come back to that in a moment. And then there's a bunch of other potential things like sustainability. Remind me, ESG, what's the E? Environmental. S? G? Governance. Environmental, social governance. SRI, S is socially responsible investing. That's right. Okay, so you can see, by the way, every single one of these is a question mark. That's because whether you're a socially responsible investor doesn't actually depend on your investor type. It tends to depend on your own personal principles and preferences and morals, right? If you're a defined contribution fund, you may have a mandate in there that actually requires socially responsible investing. If you're a fund manager, you may care about promoting ESG investing, and that will affect your investment. Now, that said, if you're managing a pooled fund and that fund has a mandate that nowhere says that you should follow ESG or SRI, even if as a fund manager you believe it's important, if it's not part of your mandate, then you shouldn't necessarily go and do it. Because typically, if you're going to follow sustainability principles, you may be sacrificing return. Now, that's fine if the investor wants you to do that because it's worth it to them, but you shouldn't go and do it on your own accord if your investor hasn't said that's what they want, because it might be that they value return above sustainability, even if you're the other way around. Public policy impacts, regret, career, and enjoyment. Now, let me come back quickly now to absolute versus relative return targets. We call an absolute target wealth accumulation or protection, and it's often referred to as a CPI plus. If I have an absolute target, what might I be aiming for? What's an example of a target? Would it be to beat the market by, oh yeah.
For example, you need 20% return from your, in the next 5 years.
Yeah. Exactly. 20% return over the next 5 years is an absolute target. It's not a relative target because nowhere there is it 20% higher than X. It is a flat absolute target. And by X, I mean something like the market. If an absolute target is higher than, it's not going to be compared to the market. What might it be compared to? So see, inflation. See that CPI plus? CPI plus? That would be, for example, not 20% over 5 years, but 12% above inflation over the next 5 years. Okay, so you're not comparing it to anyone else's performance. You're saying this is the return I want, either in real terms, in which case it's X% above inflation, or nominal terms where it might just be 20%. So it's called wealth accumulation or protection because you're focusing on having a consistent return irrespective of the market environment. A relative target is a return versus the benchmark. Okay, so it might be that you aim to outperform the S&P 500 by 3% per year. Now, there's a benefit and a cost to having a wealth target. The benefit is, let's face it, when the market is plummeting, it is very hard to actually achieve a consistent positive return. So if you're a fund manager trying to say to your investors, I am doing well, even though the market is in havoc, what you say is, all right, our fund is down by 2%, or maybe even flat if you're in a really good place. But let's say my fund is down by 2%. But if you were with the market in general, you would be down by 12. If you were with the average of my competitors, you would be down by 12. With me, you're down, but only by 2. Okay, so essentially it's like saying we're not in a perfect world. Sometimes markets are bad, but I'm doing as well for you as I possibly can. The downside of that is that what absolute return investors say is you can't eat relative returns. what would they mean by that? Sorry? It's not real money and that you're losing it, or? Yeah. So even if you perform better than someone else, you're still losing money, right? So if you have calculated an absolute target, being that you want a return that gives you a certain amount of money each year, and that's what you think you can comfortably live on, even if your fund is doing better than everyone else, if they're giving you a lesser or a negative return, you are not living comfortably, right? You can't eat relative returns. Literally means if you're losing money, you don't have enough to live on. You don't have enough to eat with compared to what you decided you needed. So we're going to see that some will have both, some will only have one, and how you invest is very much going to depend on whether you do have a relative or an absolute target. Okay, so let's start with defined contribution pension funds. They have a question mark against maximising expected utility of wealth or consumption. Question mark because unless you're a Smurf, and we're putting Smurfs as private investors at the end, you're not investing for you, you're investing for someone else. Now, anyone in economics in the room, can you directly compare different people's utility? Can you really put a number on utility? It's hard, right? It's hard for people to compare directly and manage other people's utility levels. It's a measure of personal satisfaction or happiness. So you might like to maximise the utility of the end investor, but it's a bit hard to focus on that. You can have a utility function, but more directly relevant in terms of what the fund, the defined contribution fund can do is aim to maximise their consumption in retirement, which is what we said at the start of today. So the big tick for defined contribution funds is to maximise the end investor's consumption when it comes to their retirement. They typically, therefore, do have absolute return targets because you want your investors to be able to retire comfortably. But you also, particularly in Australia, tend to have relative return targets as well, because that's not everybody, but a lot of people are in funds with member investment choice, which means that they can move around. I mean, as UniSuper, as an industry fund, I don't have the same level of member investment choice. I can have a self-managed super under certain criteria, but I can't just go off and pick any fund as I please. Luckily, UniSuper is doing really well in the league tables at the moment, which helps. But if you are in somewhere with member investment choice, then if you as a fund are doing worse than your peers, the chances are you're going to lose your investors because they're going to go to someone else that is a direct competitor but doing a lot better. So if you got, I don't know if some of you will have seen them, some of you may not have noticed, but they often have superannuation fund league tables reported in terms of how well each super provider does, right? People will be looking at those, and if they see their super fund towards the bottom, and they see it like that for a while, the risk is that they're going to go, you know what, I should be up here, and they'll switch. So that's why they tend to have relative targets too. The others, mostly they're question marks. I mean, some will care about sustainability, others won't. Regret will typically you don't want to regret any investment decisions that you've made, so that can matter. And I mean, you'd hope that people will enjoy their jobs, and so enjoyment might be part of it. Career of manager is certainly an issue for a defined contribution fund. Because if you're a manager of a defined contribution fund, you want to be successful and keep your job, you've got relative targets and absolute targets, and you're going to care about meeting those. So, from an altruistic perspective, you want to maximise consumption in retirement. From a selfish perspective, you also want to keep your job, so your career will matter. Any questions on any of those ticks? All right, so defined benefit funds. Remember, if you're a sponsor of a defined benefit fund, you will put money aside, you will get money on behalf of your employees put aside, and you will manage that with the aim of meeting the defined benefit payouts to your employees. If you don't meet the required benefit payout, as a sponsor, you need to contribute the difference. If you have more than that defined benefit payout, you get to keep the surplus. So you don't care about maximising the utility of the end investor. Nothing you do is going to be about maximising their utility. They're going to get what they're promised. You also don't care about maximising their consumption in retirement because they're going to get what they promised. You care about those middle three that don't matter to a defined contribution fund. You want to meet your liabilities, minimize your contributions, and end up profitable at the end of it. Now, the way to think about it is that liability-driven investing is all about whether you're in surplus or shortfall. And we'll talk about this a bit more in week 5, but you can essentially define a surplus as equal to your assets less your liabilities, right? And you want it to be greater than 0. That's a surplus. If it's less than 0, you're in shortfall. I'll come back to this when we look at risk measures. But one of your key, if you look at the table, the first one that you had is meeting liabilities. In other words, you're going to have liabilities, the amount and timing of which are not in your control. You need to make sure that your assets are sufficient to meet those liabilities. If they are not sufficient, you need to come up with the difference by making a contribution. So your first objective is to meet the liability. The other objective is to minimize the contributions that you have to make, right? Because that comes out of your own pockets. It's this tension that has actually led to defined benefit funds in the past getting themselves into a bit of trouble. Because before the GFC, we had a beautiful run in equity markets. There tended to be a very high equity weight. Because let's face it, if you're a DB fund and you want that fund to cost as little as possible for you, forget about risk for a second, just think about the money you put in. If you need that money to grow to $1 billion, and you want to put as little of that money aside yourself as possible, would you pick equity or debt? Equity, right? Because the average rate of return is higher. So to minimize contributions, defined benefit funds were having high equity weights. But of course, equity is more volatile. Sometimes assets are high, their equities are doing well, and you're in surplus. Other times you're in shortfall. And of course, in the GFC, equity is down. You've got a high equity weight. A lot of defined benefit funds were in shortfall, and they therefore had to make major contributions. Some of those funds couldn't, and that's why they ended up in a lot of trouble. And of course, through all of this, you're going to care about your profits, the impact on profits. This is a particularly big issue in Australia now, because a few years back, the accounting standard, I think it's 119, was changed. And what happens now is that defined companies that have defined benefit funds, right? If you're a company that has a defined benefit fund of which you're the sponsor, then you need to report the surplus or shortfall on the balance sheet of the overall company. Which means that if you have a major shortfall in your defined benefit fund, that's actually affecting your bottom line as a company. And if it's impacting your profits, it's probably impacting share price as well. So now there's been a move away from equities towards safer fixed income and lower surplus volatility, because it's actually affecting the company overall, not just a defined benefit fund within it. Because it's perception as well. Even if you have volatility, but you know you can meet your liabilities, even if you have to make the occasional contribution, that's still causing volatility in the profits of your company, which might be sending negative perception to investors. It might be affecting the amount that you can pay out as dividends. And we know that an unstable dividend can have a bad signalling effect too. So we'll go into that more in a few weeks' time. There's a bunch of question marks again under other. They may matter, they may not, depending on the fund. Now, if you have a look at insurance companies, remember they collect premiums from investors, they collect premiums from their clients, they invest those premiums, and the premium plus the returns they earn need to be at least enough to make any payouts. If it isn't enough, they need to come out with a difference. If it's more than enough, they have a profit. They are essentially identical to the objectives of a DB fund. The difference is there's no tick under minimising contributions. Why do we not put a formal tick under that? What do defined benefit funds have to do that insurance companies don't? Yeah, an insurance company will only invest the premiums. If they end up with a shortfall, they need to come up with the rest. But in a defined benefit fund, if you're a sponsor, you're putting money aside on the employee's behalf. If you're an insurance fund, you're just investing the premiums you collect in order to meet whatever payouts occur. So you still need to meet your liabilities, and if you can't, it will cost you. But you're only investing the premiums that you get from your clients. And of course, you care about the impact on profits because you want to end up with more assets than insurance claims because you keep the difference. Endowments and foundations, right? So think about the Bill and Melinda Gates charity. Think about the Harvard University Endowment. There is a question mark against maximising utility here because, particularly for charities, you are doing good, right? So it could well be that you are in the game to do good and you gain utility out of knowing that your investments will increase the charity, that will increase the good that that charity is able to do. Probably a bit less on the endowment side. I mean, I'm sure that there are some people that are in the Harvard endowment that just love that university and feel good knowing that they can further the objectives of the uni, but it's big in charities. You can see that the next two big ticks are supporting spending programs and absolute targets. Now that first one, supporting spending programs, that's the biggest objective of an endowment and foundation because that's what they're set up to do. Right, the Bill and Melinda Gates Foundation is set up so that the donations and the return on the donations will support the charitable programs that they have. The Harvard Foundation, same thing, but to support the goals of Harvard University. The ANU Endowment, same thing. Possibly partly to fund all this rebuilding in Union Court right now, which I hope I will be very grateful for in a couple of years. Right now I find it really annoying because I never know my way around. Okay, but you're trying to further you're trying to generate a return that's going to support the spending program that's being set. Which means that you have an absolute target, but not typically a relative return target. The absolute target is your target is whatever is needed to support the spending program, right? So if you take the student managed fund, for example, we have an absolute target because we are trying to generate an amount that will meet a distribution every quarter that's taken to fund a particular scholarship that is the key outcome for the fund. We look at it as CPI plus because we want to maintain the real value of the fund while keeping the outflow that is enough to support the scholarship. But we don't have a relative target officially. We have a benchmark that we're aware of, but not a relative target officially because at the end of the day, we're not focused on how we do versus the Sydney Student Managed Fund. We're focused on whether we achieve, or the students that are running this fund and investing the money, whether they are achieving their 4% distribution and the size of that distribution. Think about the Harvard University Endowment. They're not really going to care about how they perform relative to the Yale University Endowment because the people that have given money to Harvard have given it to Harvard because, let's face it, probably that is their university. And if the endowment doesn't perform well in any given year, they're not going to say, look, I never went to Yale, I have no connection with Yale, my money isn't coming back to me, it's going to support Yale, but, you know, hey, they're getting a better return. It just doesn't make sense, right? And you've picked a charity because you care about the causes. You're not going to look at how that charity performs on a return side and use that as the sole consideration to move charities. You're much more likely to look at the spending programs and ensure that they're being administered well. So the focus is just making enough to keep meeting the targets. It is less about how you do relative to a benchmark. Sovereign wealth funds, well, each country will have a very different fund in terms of what they want. So the one thing we can say they all want, their one tick, is to impact public policy. What public policy is will differ. There are some question marks in that some governments may have a sovereign wealth fund to meet their liabilities. Some may look at supporting spending programs. They may have absolute or relative targets, but they are there to impact public policy. So they're your big aggregators. The last two are your individuals. You've got fund managers and self-managed super. If we start with fund managers, the first thing they're going to care about is the impact of their fund on profits, because if they are profitable, they will look good for the company they work for and they'll keep their jobs, right? At the end of the day, they're working for somebody and they want to do good by their employer. They may have absolute targets. Hedge funds, for example, will typically have an absolute target. Mutual funds tend to mainly have relative targets. And hedge funds will have a relative target too, because obviously an investor isn't sold to a particular hedge fund, they may move around. So you'll tip, as a fund manager, you will always have a relative target because you need to show that you're better than your competitors and often better than a passive alternative. Some may also have an absolute target, like a hedge fund. Mutual funds don't, or not often. You may care about sustainability, you may care about regret, you will care about your career because you are the fund manager, so obviously your career matters to you. And let's hope that you are in this career because you love doing it. Fund management is a wonderful industry, but it is an intense industry. It is a hard-working industry. There are long hours. You may be operating outside of business hours in your own country and so have late nights. And it's a highly competitive industry. People want to be fund managers. They can make a lot of money. So you really do want to enjoy it because there's a lot of risk involved. I remember when I was in London at Schroders and I was talking to one of their best fund managers, and this guy he was so successful. He had this innate understanding of markets that his gut often did better than a lot of other people's models. But even he said you have a few quarters of bad returns and you feel like there's a noose around your neck and it keeps tightening. And he had the underlying confidence in his own skill, right? So you've got to love it because there are, it is high risk, it is high pressure. Self-managed super funds, they're the only ones that have a definite tick against maximising utility because they can control their own utility. You can't maximise someone else's as easily, but you can maximise your own. They may have liabilities to meet, mortgage for example, they may not. They will definitely care about consumption in retirement because it is a self-managed super fund. They may wish to support spending programs, perhaps there's a charity close to their heart. They will definitely have an absolute target because they will want enough to live on. They may have a relative return target. It might be that they want to do better than they would have had they delegated to a fund manager. Or they may just want to do better than some of their friends that also manage their own super and they get competitive over dinner, whatever it may be. And the rest are question marks except here. You typically will enjoy it. Super is something that is so easily delegated that if you're going to be the 30% of funds that do it on their own, it's typically going to be because you get a tick out of it. Okay, so thanks guys. I know that this has been a long first half. Let's take a 5-minute break and then we're going to go on to the nature of risk. We've spent the first part of the lecture talking about objectives because remember I said at the start that you can't decide risk without knowing objectives because the risk will flow on from what it is the investor wants. We're now going to spend the rest of this lecture and the first part at least of the workshop going through the remainder of the slides, most of which focus on risk, and then talk a little bit about some of the sort of offshoots related to risk, like illiquidity risk, for example, but that aren't your original perception of risk, which is more your volatility. So we're going to look at lots of different types of risk from now on. The slides from now on are much more self-explanatory, so we'll go through them with a lot less time per slide. But again, I don't want to rush through any of my explanations. So what we don't finish off, we're going to do in the workshop tomorrow. So risk is a tricky thing to master, partly because to an extent it's very difficult to define. Taping? Yeah. Think about it this way. Risk is intangible. You can't see it because all you can see is the return that eventuates. Return is easy. We all want more to less, and there's only one or two ways to measure it. Risk is harder because we can look back and look at volatility. We can look forward and look at what we predict the spread of outcomes to be. But at any particular point in time, we're not observing risk. we're observing the one outcome that was one of many possibilities, the possibilities of which is why the risk was there. Right? So it's difficult to measure, and yet it's absolutely vital, because we don't evaluate anything on a pure return perspective. We learned from the beginning of Foundations of Finance that it's always return relative to the risk involved. What that risk will be will differ, but it's always relative to the risk. So I wanted to start off by talking about this quote from Ben Graham. The essence of investment management entails the management of risk, not the management of returns. Risk needs to be constantly monitored and managed. And as we go through the discussion of risk, what I really want you guys to keep in the forefront of your minds is that quantitative risk measures only take you so far. Quantitative risk measures will show you the risk that has happened in terms of the outcomes that eventuated, right? Like if you look at volatility of market returns, it shows you how much markets moved in the past, but it doesn't tell you why. And it's only when you can understand why things happen the way they do that you can start to identify risks and protect yourself against them before they actually occur. To show you this, I'm going to ask you a couple of questions, and then I'm going to move into a very infamous financial instrument. So I'm going to ask you guys to pick which you'd prefer if you want to minimize risk. Would you rather secured debt or unsecured debt? Which would you pick to minimize risk? Secured debt? Would you pick a single debt instrument, or even just a single investment, or a pool of investments if what you want to do is minimize risk? A pool, diversification, right? And would you pick, if you just are looking at minimizing risk, would you pick equity or would you pick debt? Debt. Who here has heard of three letters called a CDO? What does the C stand for? Collateralized? How do I spell collateralized? Someone tell me. This is awful. When you teach, you generally, how you spell goes out the window. Collateralized, however you spell that is what I mean to say. Debt, I'm going to look at that tonight and go, oh my God, Anna, how could you not have spelled that in the moment? What's O? Obligations. So what do we have here? We have essentially a pool of debt instruments. So a CDO is backed, by a pool of debt instruments. And it's essentially a neat way to package together and sell instruments that would be difficult to trade on their own. So first of all, collateralized, we're talking about secured debt, right? And it's not over a single debt instrument, it's over a pool of debt instruments, loans, mortgages, whatever. And it is debt, not equity. So this ticks all of the boxes that we've just said we'd go to for a safe investment. And the concept of a CDO, even before the GFC, it was nothing new, and it was also nothing bad, right? This is a sensible concept in terms of everything we've learned, and in terms of enabling an instrument that would have otherwise been difficult to trade. It's hard to buy and sell a mortgage. It's a lot easier to buy and sell a CDO. And yet, they ended up in the center of a devastating collapse in the GFC. So what was the problem? What was seemingly innocuous instruments doing in the center of a devastating collapse? The trouble is, what happened with these is they kept getting tranched and tranched and tranched up, and risk kept getting packaged and repackaged and repackaged and repackaged, to the point that even though the fundamentals underlying a CDO were sound, no one really knew who bore the risk anymore. And it turned out that everyone did, because the really scary fact of the GFC is that even if none of you held a single CDO, when the GFC occurred, everyone felt the pain. The market crashed. So you ended up, I mean, there was a lot of factors in the GFC, but you might not have held any of the instruments involved. But because the problem was so systemic, you could have had vanilla ordinary shares and nothing else, and your portfolio could have plummeted. You could have just had your house in America, and suddenly you're underwater. Okay, so things that seem on the surface to be relatively risk-free may not be when you start to look at the underlying dynamics, and that's where you're going to start to get warning signs that will help protect you in the future. Now, that said, by the way, I obviously didn't predict the GFC. Most people didn't predict the GFC. But you need to stay vigilant and try to look at the underlying sources of risk to figure out if it's going to happen again. So to give you some context on the way we look at risk in this course, the first one by now should be obvious, and that is we start by what lies above. That's what we've done until now in the lecture. You need to understand your investor, their objectives, their preferences, and their circumstances before you can even begin to define what a risk is to them. Okay, so that's all about actually gaining answers to the type of things that we looked at here. And that's why, for example, if you're going to get someone to advise on your money, they're going to talk with you or maybe send you a questionnaire, undergo a lot of work to try to figure out what it is you're looking for. The next level is a level that you've probably looked at a bit more in courses before this, and that is what we call your surface risks, right? So once you've figured out what your investor is and you've filled in the question marks and blank faces in the top picture, you move into the second picture, which is a boat bobbing around on the sea. It's what you're observing. So essentially you're looking at market movements and what's happened in the past and what things like standard deviation are. After tomorrow, you can't see this on your own model pages yet because I use my sneaky little lecturer ability to tell Wattle when to show you things. But what you're going to see after tomorrow's workshop is these three things are going to come up. You're going to get the outline for your first video, the 2 parts of the video itself, the analysis file that you're going to fill out, and the solution file that you're going to check your answers against. The goal of the first video is to teach you guys how to measure a lot of these surface quantitative risks. So if I open this up, you'll be given, this is the solution file, by the way, not what you fill in, but you'll be given base data and you'll learn how to calculate the returns for your investor, for your benchmark, the difference, you're going to compound them up, etc. And the thing you're going to fill in then is all these summary statistics. Arithmetic mean, geometric mean, standard deviation, probability of loss. These are the surface risks, and you can see you measure it by observing what happened before. So these risk measures are useful. They're what tells us that equity is more risky on average than debt. It's what tells us that there has been a GFC in the past, that there has been a dot-com bubble and burst. It tells us that World War IIs have been disruptive. But it doesn't tell us why. So it's not enough to see the boat bobbing in the surface. You need to understand what's happening underneath that's causing that movement in the water. All right, so in the third picture, we're not looking at the boat bobbing up and down. We're analysing weather charts, trying to see what's happening in the water, what's happening in the wind, the temperature, whatever it is that these weather people do, to figure out, to try to predict ahead of time the conditions that will affect that boat. Right, so think about a tsunami, right? You can see it occurring, but it's caused by an earthquake deep out at sea. You need to understand the initial causes so that that will ideally raise flags that will tell you that something bad will happen, rather than waiting till it's already happening and looking back and seeing that it did. So if you think about the GFC, and I'll come back to this in a moment, but see how I say in a later slide the true nature of risk can be hidden. We observe the GFC happening, but what are some of the causes in hindsight? Low interest rates, easy credit, a highly leveraged property market, gaps in regulations, issues with credit rating agencies, mismanagement and misunderstanding of risks of a lot of these financial instruments. Now let's have a look at the first two, low interest rates, easy credit. Can anyone tell me what is the single biggest market crash we've experienced in history? And it's not the GFC. I think I just heard it. The Great Depression, right? In the early 30s, after a decadent 20s, what did people have? They had an easy supply of credit. It was easy to get money. It was easy to borrow. There was a rationality and exuberance in the system. A lot of the factors that underlied the Great Depression did come back in the GFC. Admittedly, not all of them. There weren't CDOs. There wasn't the same issue with property. But the underlying human factors, a lot of them were consistent. I'm almost scared to ask this question, but to get you an idea of how easy it is for this to happen, how many people were less than 10 years old when the GFC started? Any hands? Okay, how many weren't yet teenagers? I can see some hands. It's making me feel really old, but I can see some hands. Think about it. You guys, you weren't teenagers yet with the GFC. You're learning about finance. You're learning the causes, but a lot of people aren't. And the GFC feels like yesterday to me, because I'm ancient, but I'm guessing to you it must feel partially like a concept, because you weren't yet at university. Equity and debt probably wasn't much of a concept to you unless your parents really spoke to you about finance in a way that mine never did. So if you think about it, lessons can be so easily forgot. They can be easily missed because they might never have been learnt. And yet some of the underlying factors, even if they eventuate in different ways, they can be the same. So that's why it's really important not just to look at quantitative measures, but gain a qualitative understanding. And one of the things we're going to look at a little bit in this week's topic, and more so in week 5, is what we call the fundamental risk approach. The fundamental risk approach almost ignores quantitative measures altogether. It's all about identifying the underlying risk factors in the economy, in your portfolio, and in valuation of investments. So to keep going on this view that risk is varied, it's not just the type of risk and the risk triggers that are varied, it's the way people view risk. So here are some definitions that I think sort of bring up different aspects of risk. The first is by a guy called Chris Cuff, who's the chair of UniSuper. He said the word risk is a bit like the word love. It has multiple meanings depending on who is using the word and in what context. I love that definition. It's particularly true for me because I'm somebody that, obviously not talking about people, but talking about things, I will be really over-liberal with what I say I love. You know, oh, this song, it's the best song I've ever heard in my life. I love this song, it's amazing. And then 5 seconds later, oh, no, this song. Oh, no, this song is the one I love the most. You know, this is the best. Because that's just the way I express myself. So if someone comes to gauge my own view of my preferences and they don't consider the way I am as a person, then I'm going to say I love everything. And they're going to go, great, this girl's really easy to please. You know, let's just give her every asset I feel like. But you need to understand the context that I say it, because it actually means a bit less when I express liking something compared to, if I go back to the example of my mother, if she says that she loves something, then it matters, right? If she says she likes a movie, I go see that movie. If I like a movie, well, it means I've seen it before, basically. So if you think about risk aversion, same thing. If I say, you know, oh, I consider myself risk averse, and I do say that, it's not as extreme. It's the same reason that when you come out of hospital, you're asked to not just say, are you in pain, but what is the pain out of 10? And they're not gauging the initial starting point, they're gauging the trends, right? If I have a headache, I'm going to say I'm in 5 out of 10 pain, because I tend to over-exaggerate. Mum came out of surgery and literally woke up and said, oh, I feel in a bit of pain, I guess I'd call it 2 out of 10. So now that the doctor knows 2, if she suddenly went to 4, that matters, right? Whereas if I called it a 4, it means that my headache's getting better. So it's really important to understand your investor and what it means when they express a word, particularly a word like risk. The second one is a bit more dry. It's by a very well-known and very good academic, but it's a classic academic definition. And it's the one that you guys would have learnt most of your courses until now. Risk means more things can happen than will happen. right? So if I was to say what quantitative risk measure was exactly that definition, what would it be? What's the main risk measure that you use? Variance, standard deviation. Exactly what that means there. All standard deviation is saying is you have a spread of outcomes around an expected outcome. More things could happen than end up eventuating. It's a very correct definition, but it doesn't really get to the heart of what we see as risk. Because if we expect a return of 20% and return is 30%, is anyone going to complain? I'll be pretty happy. But if the return is negative 30, I would be very upset. So the thing I like about the third definition is it keeps the view of uncertainty that Dimpson said, but now it gets more to the heart of what actually hurts us. It is the risk is the possibility of an adverse outcome, right? It's the chance that something could go wrong. So it's not that I end up with a higher return than I expect, it's that I end up with a lower return. And even then, we can come more specific, more focused on the investor by saying, what is the adverse outcome? Well, it's not the same for everyone. It's a failure to meet the objectives of the investor in question. So I love this third definition. Love. Sorry, that was accident. I told you I use it all the time. I really like this third definition because it gives you that direct link, right? You can go straight from the investor to what their risk measure is, because once you know their objectives, you can define an adverse outcome. And I'll give you some examples of different measures in a moment. The other thing that muddies the waters a bit, that makes it more complicated, is that you do have multiple stakeholders. So what risk is will depend on the perspective that you take. Think back to last week. Remember we said that there's a conflict of interest between an end investor and a fund manager, particularly the fund management company. Because the fund management company wants to maximize assets under management, because their profit is their management fee times the assets under management. More assets under management, better for them. So their risk would be a drop in assets under management. Perhaps a bunch of investors leave the fund. Think about the end investor, particularly if that fund is active and trying to invest in underpriced stocks. Their risk is not that assets under management go down. In fact, if assets under management go down, that could be good for them because it means that the fund overall is less likely to shift the market price when they buy an underpriced stock. For the end investor, their risk is that assets under management goes up, the exact opposite of the fund management company. Because with too much assets under management, if you find an underpriced stock, but you have a huge amount of money to put into it, probably you are the one that's going to shift the price back up to its true value, if not above. Right? So the end investor, their risk is that the fund gets too big, or one of their risks. For the fund management company, their risk is that assets under management fall. So it's all about identifying who your key stakeholder is and managing it for them. So remember, if risk is a possibility of an adverse outcome, let's keep that in mind to understand why we have some of these risk measures here. If you want to maximize expected utility of wealth or consumption, then you're going to care about asset portfolio volatility, and in particular drops. But the reason that I'm putting volatility there is that if you're a risk-averse investor, typically your utility function will have a direct penalty for volatility. Right? If you guys are doing economics and you've looked at utility functions, you'll see that the higher the volatility, you're going to actually have a penalization. But if we get more if we get more to the heart of what it means to be unhappy with your utility, what we care about specifically is drops. Which is why more and more measures like downside deviation, as opposed to just standard deviation, downside deviation is becoming increasingly popular. If you care about meeting liabilities, then your risk is that you don't meet your liabilities. So the key risk to you is either going to be surplus volatility, right? Because if you've got volatility, sometimes you'll be in surplus, but other times you'll be in shortfall. Or to be even more direct, what you care about is times where you're in shortfall, because then you need to make contributions to come up with the rest. And that directly links to the third. If you want to minimize contributions, then your risk is that you'll end up in shortfall, because it's in shortfall where you need to make the extra contribution amount. But that said, there is the tension that we'll talk about in week 5, that if you don't think about contributions because you've met a shortfall, if you think way back to when you're deciding your investment, if you want to minimize contribution at the start, then you might want to invest in a higher weight in equities, because on average the growth rate's higher and it will end up doing more of the work for you. So you put less money in, the assets grow more and they meet your liabilities. But of course there's a risk that the equity market goes down and you still have a contribution because you have to come up with the rest. Defined benefit is, or liability-driven investing in general, is a real tension between how much do I put in now and what is the risk I may need to put in a lot later. Profit impact, well, if your key focus is your profits, then obviously your risk measure is going to be a volatility in your profits or a drop in your profits. If you care about consumption in retirement, supporting spending programs, or absolute targets, then these are all very specific goals. It's not about volatility so much as not meeting your goals. It's shortfall in each one. If you use consumption in retirement as an example, we have this thing that we like to call a replacement ratio. Now, a replacement ratio is essentially the proportion of your pre-retirement income that you'd need to maintain the same or a very comfortable standard of living in retirement. Does anyone know what we tend to aim for if we want to maintain a very comfortable standard of living? So essentially we don't want to have a big drop in our welfare, what that replacement ratio benchmark is? It's about 75%. Some say 70, some say 80. But if you want to maintain real comfort through retirement, you're aiming for a replacement ratio of about 75%. So you might see a shortfall as a replacement ratio of less than 75%. If you have an absolute target of 20% over 5 years, your shortfall would be less, ending up with a lower return than that. If you care about relative performance, you care about your tracking error. Now, your tracking error, which you also calculate in the Excel video, is where the crudest measure of tracking error is that you take your return, you subtract your benchmark, and you take the standard deviation of the difference. So if I go back to this Excel file, see how you've got your returns, so the portfolio less the benchmark, this is your relative return series. Your tracking error is the standard deviation of the difference. Here the tracking error is 4.71. That's actually a pretty high tracking error. If you look at equity funds, 1% tracking error is low, 5% would be quite high. And obviously a high tracking error means not necessarily that you're always underperforming your peers, right? If you were always doing worse, your tracking error could be low. It's that sometimes you're doing better, sometimes you're doing worse. And so it's very much a standard deviation style measure of risk. But it's a standard deviation relative to your peer group. Another one could just be the probability of underperformance. So see how we've got a probability of loss here. This is a column, your peer group less your benchmark. When this is negative, your portfolio less your benchmark. When this is negative, you are underperforming your benchmark. When it's positive, you are outperforming. So you might want to look at the probability that you underperform your benchmark. And that's the type of thing you would look at here. This is a database one. So you essentially count the number of times you underperform compared to the overall observations in your series. And you might say, I want my probability of underperforming the benchmark to be no more than 30%, in which case you violated it quite badly here. So you can see that the right risk measure for you, all these different options, but the one that you focus on is going to depend on what you want out of an investment. And if you care about regret, then you might care about the probability of making a wrong choice. And obviously you wouldn't want that to be more than 50%, or you'd wonder what you're doing. Now, I'm not going to go through a lot of this in detail because we're close to the end, but I just want to talk about this top part quickly, because that relates to the Excel file I just got up. There are a number of issues with using just quantitative risk measures, and I'll take you through these in the workshop tomorrow. The first one is that you need to characterize the distribution of returns in some way, which means you need to make assumptions and you could be wrong. Now, one thing you need to decide is, am I going to use a model-based or data-based distribution? A model-based distribution is something like assuming a normal distribution, so only mean and variance matter. A non-parametric or data-based distribution, you are taking observations directly from the data. These are sometimes concepts you haven't come across, so all I wanted to do is show you that you do both of them in a video. Calculate, say, the probability of loss. Parametrically, you will do that through your Z-score. Non-parametrically, you will do it by counting the number of times you make a loss and expressing that as a proportion of total observations. So both of those you're going to learn how to do in the video. All right, guys, let's leave it there, and I'll go through the rest of the slides in the workshop tomorrow.